Good day, everyone, and thank you for watching this video. To all of our clients and friends, I hope you all had a wonderful Christmas and perhaps now heading back to work or still on vacation, trying to have a good time. Just be safe and hopefully you continue to enjoy the holidays. Meanwhile, many of you have emailed me, have asked a number of questions as it relates to the Tax Cuts and Jobs Act, trying to figure out how it impacts you or will impact you, and so on and so forth. There are three things that I want to talk to you about today that are, to me, most important in terms of what you do now. Obviously, on December 22nd, 2017, President Trump signed the Tax Cuts and Jobs Act into law that provides a number of changes. This is one of the most sweeping change in the tax code in the last 30 years. So, and this is something that has major ramifications impacting everyone, individuals, businesses, and so on and so forth. So we all are very concerned about what's in these laws and how they're going to impact us. And it's our responsibilities as professionals and others to educate our clients, to educate the general public overall in terms of how these laws will be impacting them. I said there are three things that I want to talk to you about. First, let me say I'm Hudson Robillard from the CPA office of Hudson Robillard and Company. It is always a pleasure to share or information with you or find information that I find to be educational, as everyone has a responsibility really to make sure they comply with these new laws once they become effective. One of the first things that I really want to talk about is when will these changes be effective, and that's key and that's very important. I went through a survey that I found relating to this topic, saying that nearly 3/4 of Americans think this new tax reform bill will impact the current year tax return. That's a survey done by Liberty Tax Services. Specifically, close to 50% expect to see their 2017 taxes go up, while 22% expect to see their taxes go down as a result of the latest changes. Reality, however, is that they're all wrong because of the simple fact that these changes will fully be implemented in 2018. They don't apply to current year. So that's one of the very first thing that I want you to know and understand, that yes, we do have some upcoming changes, but they do not impact your 2017 tax returns that will be filed in 2018, and that's very important. However, there are a few things though that you can still do in anticipation of what some of those changes are going to be in 2018. There are some things that you can do in 2017 to minimize your tax liabilities and increase your tax refund. If you believe you're going to have a higher taxed liability in 2017, there's stuff that you can do to reduce that, and there's also stuff that you can do to increase your tax refund, and I'll talk a little bit more about that as I am coming back to this point. And the other thing that I want to talk to you about that a lot of people have questions on is the impact of the repeal of the individual mandate for Obamacare. Obviously, we just finished with the session where everyone selected a plan under the Affordable Care Act for 2018. I must tell you, during the whole 2018, there is continued requirement that you do have health insurance, and the repeal does not necessarily does not mean the whole Affordable Care Act is repealed. It's just the mandate, the requirement that individual carry health insurance, that will no longer be in 2019 per se. Obviously, that alone is going to have some significant structural impact on the Affordable Care Act, because this provision here is sort of foundational for the sustainability of the program, based on how it is built. If you have any understanding of the insurance market, it's a risk-based market, and what's going to happen as a result of this, and I've already read some studies or anticipation that nearly 13 million of people will drop out of coverage in 10 years or so as a result of no requirement for them to carry health insurance. What's likely to happen, as I said before, the Affordable Care Act is still there. That means the health insurance market for individual is still there. So people that are deemed high risk are likely to be the one to sign up for insurance. And those that feel like they're a little bit healthy are likely to not sign up for insurance. As a result of that, you're going to see an increase in claims versus the premium that's coming into the system. As a result of that, you will have what you call premium increase. So it remains to be seen overall how this is going to completely impact the Affordable Care Act, but unless something is done to control premium from skyrocketed, it's likely to have detrimental effect in the long term to it. So we'll wait and see what's going to happen, and again, it's all a matter of legislation in terms of how they fix the healthcare system. The third thing that I wanted to talk to you about, like I said, things that you can do in 2017 to impact, to minimize your tax liability or to increase your refund. Some of the things you probably never think about. Increase your charitable contribution. How can increasing your charitable contribution impact your 2017 tax return? Again, through the charitable contribution deduction, though the charitable contribution deduction won't be going away next year, any donation you make in 2018 will only serve for the purpose of helping out with your 2018 taxes. Now, if you want to lower your taxes for the current year, then you'll need to get moving on those donations before 2017 draws to a close. So what I'm saying is you can increase your charitable contribution. That will help reduce on your increase your deduction, reduce your potential tax liability per se. Now, keep in mind, it's not just cash donation that help your taxes. So, because oftentimes when you talk about charitable donation, people think it's just donating cash. No, you can donate goods to a registered charity, and you can take a deduction for the fair market value of that item, which is the amount that they go for in their present state. You'd also be allowed a deduction for the money you spend volunteering. If you running a late December food drive at your church, for example, and if you spend, let's say, $60 or $100, or however, your own money on packing supplies and stuff, you can write off that amount on your taxes. While many folks are naturally inclined to be more charitable around this year, if you have reasons to believe that you will owe money on your taxes, say you got a larger than expected bonuses, something that may increase your tax for 2017, or if you, I don't know what your investment portfolio looks like, but if you just sold some investments out of profit that tends to increase your taxes, then it pays to offset these extra income with some last minute donation. It's a great way to give back and shield money from IRS at the same time. So that's something for you to consider. The other thing that I was thinking about, and again, a lot of this information I'm sharing with you comes through an article with Yahoo Finance, and I found them to be very interesting. And I said, well, as I'm putting this video together, I should share that with you for your consideration as well. If you're looking for a way to lower your 2017 taxes while also benefiting yourself in the future, then now is the time to stick with some last minute money into your 401k. So using your 401k to dump some additional money into it. How does that work? You got to keep in mind you have a maximum amount that you can contribute to a 401k. That is $18,000 for workers that is under 50 years of age, and $24,000 for those 50 years and older. You may have probably read that these amounts are expected to change in the new law to $18,500 and $24,500 respectively, but these will only take effect in 2018. In other words, if let's say you're 36 years old and your final 401k contribution for the year as it stands will bring you up to $18,000 if you want to make this additional contribution, and there's nothing left to be done. So if you are well below that threshold, then it pays to move on this last minute boost to make sure you do this. Now there's something also I got to tell you about this additional deduction in terms of how it runs. You should know that in some cases it may be too late, especially if it takes several pay cycles to implement a 401k changes at your company. But if your employer can accommodate this request, you'll be doing yourself sort of a big favor by boosting your 401k contribution by the end of the year. So that's one thing you could consider to do. The third thing I think is sell underperforming investments. If you sold investment this year at a profit, then you'll need to factor capital gain taxes into your final IRS tax bill. On the other hand, if you have investment sitting in your portfolio that aren't doing particularly well, selling them by the end of the year could get you out paying those gains, right? That's because investment losses serve the key purpose of offsetting gains. That's kind of like how it works. If your losses equals your gains, they'll completely cancel each other out. That's how it works right now. In addition, if your net losses exceed your net gains, you'll get the option to apply $3,000 against your ordinary income, right? Capital gain income versus ordinary income. You can only offset ordinary income by $3,000 of capital losses. But don't wait. If you don't unload those investments, let's say by end of this week or next week before the 31st, they won't help you as far as your 2017 tax return goes. So if you want to use these losses to offset your ordinary income at least by $3,000, you would have to do them before the end of the year. So as anxiously we are waiting the tax changes that are set to take effect in 2018. Spend a little time working to lower your tax burden right now, which is kind of like what we were talking about and how we can help with that. That way you have less related item to stress about going into next year. So these were some of the key points that were made in this article. Now, another thing that I'm observing, I'm reading different reports, financial reports about individual in high tax rate states for property taxes. There are some states that have higher rate than others, because next year we anticipate a cap on property taxes deductions. What some people are currently doing is paying those property taxes in 2017 so that they can use that as a huge deduction or itemized deduction in their 2017 tax return, because next year it will be capped and they won't be able to do these types of deductions, because again it'll be limited. The three things that I wanted to talk to you about is to understand that these changes that are expected, they will not have any impact on your 2017 tax return. So your 2017 tax return will remain what they are as of current tax law. The impact of the repeal of the individual Obamacare, the individual mandate for Obamacare, of course, this has been repealed, but they won't be effective until 2019. For the whole 2018, you need to make sure you maintain your health insurance through the Obamacare. And also, it doesn't mean that the whole Affordable Care Act is repealed, it's just the individual mandate. That means if you want to continue to have health insurance through the Affordable Care Act, you can continue to have your health insurance through the Affordable Care Act and also continue to have subsidies, because many of you will continue to qualify for subsidies for the government to continue to help you pay for the premium of your health insurance plan, provided that you qualify for it. The third thing was some of the things that you can do now to minimize your tax liability for 2017 and maximize your refund for 2017. We just share a few of the things that you can do. Once again, my name is Hudson Robillard with the CPA office of Hudson Robillard and Company. If you do have any questions regarding this information, feel free to reach out to me. You can call or text me directly if you want. 305-610-9819. It's a number to contact me. Or if you want to email me, you can email me at info@hrcocpa.com. It's info@hrcocpa.com. Again, my number is 305-610-9819. Feel free to reach out if you have any questions regarding this presentation. In my next video, I'm going to talk about some of the key changes expected for 2018, which is going to be a little bit very different format or presentation in terms of the information that I will discuss with there. Please, if you like the information, please share it with your friends, with your family, as tax season is very near. And if you have any questions and would like to reach out to me again, feel free to reach out. 305-610-9814. Thank you for watching.